So if you're not investing in something that's growing, you're already losing right there. VU annual compounded average growth rate for 15 years is right at 14%. The bigger and faster the company grows, the more you own within that company, the faster your portfolio will grow. So if you're not investing in something that's growing, you're already losing right there. During the dot-com crash, it fell 80%. That's crazy. But SCHD, they're focused on stable, reliable companies that have been increasing their dividends over 10 years. The basic of a good ETF is they're diversified, they're very profitable, they have historical performance, they have low fees, and they're resilient throughout crashes. How can you buy on a dip? Buy on a dip using the RSI or the EMA. Those are some of the two easiest ways. The best tip is to start investing in ETFs and then invest in the companies that are held within that ETF. Y'all finna learn a lot about building wealth passively, how to erase the wealth gap, and how to fund your whole lineage lifestyle. Most beginners always lose in the stock market because they pick the wrong companies. Well, today I'm gonna show you 3 to 4 ETFs that choose the most profitable, diversified, have historical performance, has low fees, and resilient ETFs that hold over 100 companies. Stop buying individual trash companies. If it's not profitable, don't even buy it, because that's not even an investment. That's just a donation. You're giving your money away to somebody that's gonna lose it. I'm not a financial advisor, but I do have disciplined diamond hands. VU is a safe ETF. VU has been growing at a rate of, let's check out VU. VU annual compounded average growth rate for 15 years is right at 14%. So if your account ain't making 14% per year, VU would definitely do that for you. What companies are inside of VU? Well, they hold the top 500 most public and most profitable companies like Nvidia, Apple, Microsoft, Amazon, Google, Meta, Tesla, JP Morgan and Chase, Eli Lilly, Visa, Netflix. You got MasterCard, Johnson & Johnson, Walmart. Basically, look at this list, all the companies we use every day: Uber, McDonald's, TMO. So all of these companies' revenue will continuously increase because their CEO in America will continuously focus on capitalism and focus on making more profits. So in that sense, the bigger and faster the company grows, the more you own within that company, the faster your portfolio will grow. So if you're not investing in something that's growing, you're already losing right there. What makes VU so great? VU dividend yield is 1.16%. That's cool. Most of their holdings are in North America. Their expense ratio is 0.03. What is a 0.03 expense ratio? That ratio is pretty low. That means every $1,000 you invest into it, it's only charging you 3 cents. Some ETFs have a higher expense ratio, like SPY. Let's check out SPY. SPY and VU holds the same holdings. They both track the same index. Check out this. The index track is the S&P 500. It's the same index as VU, but we can see their expense ratio is 3 times as higher. Not only is their expense ratio is 3 times as higher, their dividend yield is 6% lower. So SPY costs more to own, and their dividend yield is lower. So that's why VU is one of the safest and best ETFs to own to make your portfolio grow at least 14%. Check out QQQ. What is QQQ? QQQ holds the top 100 in innovative companies in the world, diversified from technology, consumer discretionary, healthcare. Those are some of the top holdings. But what are the holdings in QQQ? Some of the holdings are similar to the VOO because they hold the top 100 tech and innovative companies besides finance. So that will be Nvidia, Apple, Microsoft, Amazon. So this is another great ETF that is resilient, that always performs despite market crashes. Like a lot of single companies or stocks that do terrible, they aren't resilient during market crashes. But as we can tell, this follows the Nasdaq index, the Nasdaq 100 index. And the Nasdaq 100 index is very resilient, just like SPY. Despite the trade war once Trump got in office, despite the pandemic, despite the wars and all the previous crashes, it always recovered. It's very resilient. Some companies aren't this resilient. You check out the dot-com crash. During the dot-com crash, it fell 80%, that's crazy. It fell 80% during the dot-com crash, but it's still resilient. A lot of companies that fall 80%, they just get delisted and you lose everything. So you want to be in safe ETFs or investments as a beginner and as a long-term holder, because if not, it's not an investment, it's just a donation. The next ETF we got that's going to really diversify your account and pay you in good dividends is SCHD. Their dividend yield is at 3.8% right now. The index it follows is the Dow Jones US Dividend 100 Index. Expense ratio is just 0.06. So that means every $1,000 you invest, it's only charging you cent to invest in them, which is very great. What are the top holdings in SCHD? Let's go over that. Well, it holds the top 100 biggest, most profitable companies that have been paying consistent dividends for over 10 years. So all of these companies would diversify you differently, because a lot of the top 500 or top 100 tech companies, they don't pay dividends. They're focused on growth. But CSHD, they're focused on stable, reliable companies that have been increasing their dividends over 10 years. So you're going to hear a lot of different names in this portfolio. So you got Coca-Cola, you got Pepsi, you got Lockheed Martin, you got Chevron, you got Verizon, you got Home Depot, Texas Instrument Incorporated, you got Ford Motors, you got Hershey's, you got General Mills, you got Regions Financial Corporation, you got Best Buy. Some of these all of these companies have been increasing their dividend for over the past 10 years, and that means that revenue has been increasing. The basic of a good ETF is they're diversified, they're very profitable, they have historical performance, they have low fees, and they're resilient throughout crashes. VU has an average return of 14% over the past 15 years. The past 5 years has been going bunkers, it's at 15%. And that's why you want to buy on a dip. Think about this. If you buy on a dip and you buy it when it's negative 10%, that means your average return going to be 25% for a year. How can you buy on a dip? Buy on a dip using the RSI or the EMA. Those are some of the two easiest ways. What makes QQQM better over QQQ is QQQM has a higher dividend yield and a lower expense ratio. Check this out. Their dividend yield is at 0.51. QQQ is at 0.48. Not only that, QQQ expense ratio is at 0.20. QQQM expense ratio is at 0.15. So that makes QQQ 0.05% cheaper, but their dividend yield is also 0.3% higher, 0.03% higher. The past historical performance over the past 5 years for QQQM, since it holds a lot of tech and innovative companies, is going to be a lot higher, but it's also going to crash a lot harder. So the past 5-year percentage growth, well, the past compounded annual growth rate has been 16%. We check out QQQ. For the past 20 years, their compound average growth rate has been 15% over 20 years. At 15 years, it has been 19%. Let's check out SCHD. SCHD 15-year performance for their compounded annual growth rate is at 12%. So each of these ETFs will allow you to hold different companies and be very diversified and give you a lot of exponential growth, allow you to compound everything you throw into them. The way I would diversify, because I'm beyond the under 20% growth, so I don't own none of these ETFs. If it was an ETF I would own, it would be XPXL. Once XPXL take a big dip, because I'm a dip buyer, I want it to come down at least around 150. At least oversold. 150 XPXL, at least oversold. But the way I would diversify my portfolio in between these ETFs, the safest would be VU. So I would go 50% VU, 25% QQQM, because if QQQM if the technology sector takes a big hit, this ETF right here is going to fall the most. So that means if it falls 30-50% in a day or 50% in a month, I don't want my portfolio to be down as much as this ETF. So I would diversify and put it in a safer ETF, like 50% in VU. Since VU holds 500 public companies and is more diversified, it wouldn't fall as fast as QQQM. Then I'll put 25% in SCHD because it's stable and it's definitely not going to fall as fast as neither of these two, but it's also stable, it's going to compound, and it's going to pay you out a good amount. What would investing $20 versus $250 a month give you? Alright, check this out. This is the power of compound investing and buying safe investments. If you ever blew your account, the best tip is to start investing in ETFs and then invest in the companies that are held within that ETF when they dip. Only when they dip. Because what the ETF is going to do, it's already going to screen the companies for you, and it's only going to put it in the most profitable, financially stable companies already. So if you're buying companies like APLD or growth stocks or neo growth stocks that aren't performing, you're going to feel that. But if you start investing in companies that are held in a solid ETF that are undervalued on a big dip, your account will feel that as well, and you will see the growth in that. So look, investing $25 a month with an interest rate of 15% over 36 years, a total contribution would just be under 11,000 bucks. But the growth would be 328,000 due to the interest. And as we can see, look, the first year interest just 24. The 10-year interest just 839. But once you get to 20 years, your interest 4,300. That's when interest starts growing. That's why they always say your first 100K your hardest, your first million your hardest. Because the more money you have, the faster it'll compound. And the lower interest rate you would need for it to even go up. If you was to make a monthly contribution of $250 a month, which is easy to make a monthly contribution of $250 a month, all you gotta do is get a car that's $250 cheaper than your current monthly payment. So that might be get a car that's 10 years older, or maybe just pay it off, and you'll be able to save $250 a month. $250 a month compounded at a 15% interest rate for 36 years would turn over $3 million. Total contribution would just be $108K. Now, like I told y'all, if you buy companies on the dip within a good ETF, your interest rate will be 20% plus. 20% plus of 250 would be over 11 million. So you could play around with this calculator, and you can definitely see the growth of investing $250 a month versus $25 a month.